So you're looking to buy a stock, but you have no idea if it's on sale right now and a good time to buy, or if it's overpriced, meaning you'd be paying too much for it. Because on one hand, if you can buy a stock that is undervalued, you can end up making great returns in the future, but if you end up buying a stock that's very overpriced, you can make no returns or even make a loss. However, luckily there is a ratio that can help us to tell whether a stock is undervalued or overpriced, and this is called the PE ratio, also known as the price to earning ratio. Now, if you can implement the PE ratio alongside some other analysis, this can be a great way to tell if a stock is undervalued and potentially result in some good returns in the future. So first, before diving into figuring out what's a good PE ratio and what's a bad PE ratio, let's first get an idea of what the PE ratio actually is. To simply put it, the PE ratio is the current stock price a company is trading at, divided by the company's earnings per share. For example, let's say we had a company, let's call them SuperValu, and they had a stock price trading at $20 a share and an earning per share of $2. This would mean SuperValu would have a PE ratio of 10, as $20 divided by 2 equals 10. Now, would a PE ratio of 10 be considered good? Well, it can depend on a number of things. If we were to base it off the book The Intelligent Investor, authored by the teacher of the Warren Buffett, Benjamin Graham, the book suggests aiming for a PE ratio of 15 or lower. So based on the book, SuperValu's PE ratio of 10 could suggest the stock is potentially undervalued. Now, the reason the book The Intelligent Investor suggests a lower PE ratio is because a higher PE ratio can potentially result in less returns in the future. And there's a very good reason for that, but we'll come back to that after we analyze another way to use the PE ratio to tell if a stock is undervalued or overpriced. Now, this method requires taking the average PE ratio over a period of time and comparing it to the current PE ratio today. So if we were to carry on using our existing example, SuperValu, if SuperValu had an average PE ratio of 19 over a 10-year period, and their current PE ratio trading today is 10, this would suggest that SuperValu is potentially undervalued, as the current PE ratio today is trading below its 10-year average PE ratio. Now, going back to the previous point where it suggested to aim for a lower PE ratio, as a higher one could potentially result in less returns in the future. Well, if we were to go back to our example SuperValu that had a current PE ratio of 10, this means for every dollar of SuperValu's earnings per share, you, the investor, are paying $10. Now, however, if you have another company that has a PE ratio currently at 60, this would mean for every $1 of the company's earnings, you, the investor, are paying $60. And so, with a PE ratio of 60, how likely is it that a company will increase its earnings per share 60 times in the future? Well, the answer is very unlikely or very slowly, thus suggesting the stock could potentially be overpriced. But the big question is, why would investors be willing to buy a stock that currently has a PE ratio of 60? Well, there could be many reasons for this, but the main reason is because investors are very optimistic of a company's future and are therefore willing to pay a premium for the company's stock. But that doesn't always mean it's going to result in returns for the investor. Just look at Tesla, for example, that had a PE ratio of 940 in December of 2020 as their stock price continued to rise. But currently today, their PE ratio is only 43, as the stock price has had a massive drop off. So with all that, does that just mean you can buy any stock that has a low PE ratio? Well, unfortunately, it's not as simple as that. Now, of course, the PE ratio is a great tool and can help you to find stocks that are undervalued, but it should be used in conjunction with other analyst tools, such as looking at management, revenue growth, earning growth, liquidity, and many other things. So if you want to learn about some of those other things you need to consider before you buy a stock, consider subscribing, as I'll be talking about all of them right here. Anyway, till next time, see you later and have a great day.